it is that time of the week again, and I am referring to EconoChat Let's Talk Business with Mr. Daniel Steinman and myself, Elsabe Tuvingani, as your hostess. We are talking debt versus GDP. Of course, the question remains, when will we see or enjoy the fruits in Namibia? Given that there are so many things that is currently put on the table, referring to oil as well.
Elizabeth, can we go home now? And when you find out what the answer to that question is, you call me and we come back and we make a recording.
Well, I think you're the best person that can give us,
Let's
some hope.
Let's talk debt GDP.
Okay.
Because people are confused.
Yeah.
In the last 2 weeks, the Bank of Namibia put out a figure, sort of a reappraisal of what the debt to GDP. I'm talking government debt.
Yeah.
Government debt to GDP, what the ratio is. This was in the same document that I think it was in the quarterly bulletin or something, if I remember correctly. But where the growth rate, GDP growth rate for the first 3 months of this year, the calendar quarter, was 4.7%. And then it was also announced that the debt has come down to 66% of GDP. It's a minor retraction. It used to be 67. But this is not the whole thing. You have to understand this dynamic, and I want to make it very simple and very clear for our listeners. Because how can they say, no, the debt to GDP ratio has come down, but when we look at the weekly auctions, we see that the debt is actually growing all the time.
Yeah.
And this is why we talk about a ratio. So that 4.7% growth means that the economy is growing faster than the debt.
Yes.
So let this sink in. The government still needs to fund their daily operations, as I want to call it, paying salaries, paying suppliers, all the sort of stuff that the government must take care of on a daily basis, because it's a very, very big company. Look at the government almost like it's the biggest company in the country. You see, so they have to borrow money continuously. In the capital market, I've explained that mechanism many times. It's through government bonds, which are dead letters.
Yeah.
Now, they are selling the same amount of debt in a month. I'm talking averages here, that they've been selling for the last 2 or 3 years. It's moderated a little, but it is not enough to make the debt go away or shrink. So the first thing you need to understand is the debt continues to grow at a slightly slower pace. But the economy is growing faster. That's why we talk about the ratio.
Yes.
So that relationship between the speed of the debt and the speed of the economy is slowing down. Does that make sense?
Yeah.
Did I put it in a way that
Very
you can
clear.
understand?
Yes.
You see, so the debt is not coming down, it's growing. The GDP is also growing. But at 4.7%, it's very much better than in COVID, or even the 3 recession years before COVID.
Yeah.
So, and last year, remember the quarterly growth in, this is also something I need to explain. In 2023, the first calendar quarter growth was 5.3%. Now, that sounds like we're growing slower now, because now the growth is only 4.7%. But here's the catch. It's not. We are actually growing faster.
Okay.
Now I've really scrambled your mind. Let me explain. The 5.3% came from the so-called low base effect. Remember, I've used the example of the diamonds. If you lose 9% of your economy and you come back, and this is what happened in 2020 and 2021, and you come back in 2022 and you very low. You at that's why it's called a low base. The level from which you make your calculation has come down, and it has come down a lot. So now you grow a little, but statistically it looks like a lot. So in 2022 we had very nice growth rates, but it is still lower than what it used to be. So in 2023 we come up with this first quarter growth rate 5.3%, and everybody says, wow, unbelievable, magic, which is not. It's simply the low base effect. It's a statistical phenomenon. So if you look at the nominal values, the Namibia dollar values, the 4.7% growth rate first quarter this year is more than the 5.3% first quarter last year.
And on that note, let's quickly go for a short break, and once we come back, we will of course continue this interesting talk.